Hey guys, welcome back to the channel. In this video, it's going to be an educational one, and we're going to talk a little bit about investing versus trading, what the differences are, what's the similarities, and just a couple of different examples I can give you as far as times that I've invested and times that I've performed a trade, and just kind of want to shed some light on those two things for you. So just to reiterate, guys, not a financial advisor. Make sure that you do your own research on any type of investing or trading that you are participating in. You're in charge of your own money. If you find value in today's video, smash the thumbs up button, subscribe to the channel if you enjoy this content, and hit the notification bell. That way YouTube can let you know when we release new content. So guys, let's dive right on into it. All right, guys, so we're on Investopedia.com. This is an article talks about investing versus trading. What is the difference? Okay, it says investing and trading are two different methods of attempting to profit in financial markets. Both investors and traders seek profits through market participation. In general, investors seek larger returns over an extended period of time through buying and holding. Traders, by contrast, take advantage of both rising and falling markets to enter and exit positions over a shorter time frame, taking smaller, more frequent profits. Okay, so it says key takeaways: investing takes a longer term approach to the market and then often applies to such purposes as retirement accounts. Trading involves a short term strategy to maximize returns daily, monthly, or quarterly. Investors are more likely to ride out short term losses, while traders will attempt to make transactions that can help them profit quickly from fluctuating markets. Okay, so investing, the goal of investing is to gradually build wealth over an extended period of time through the buying and holding of portfolio of stocks, basket of stocks, mutual funds, bonds, and other type of investment instruments. Investments often are held for periods of years or even decades, taking advantage of perks like interest, dividends, stock splits, and things like that along the way. While the markets inevitably fluctuate, investors will ride out the downtrends with the expectation that prices will rebound and any losses eventually will be recovered. Investors typically are more concerned with market fundamentals, such as price to earning ratios and management forecasts. Anyone who has a 401k or IRA in investing, even if they are not tracking the performance of their holdings on a daily basis. Since the goal is to grow a retirement account over the course of decades, the day-to-day fluctuations of different mutual funds are less important than consistent growth over an extended period of time. So that makes sense if I think about it for myself. My mutual funds that I'm in, I don't look at them every day. I might look at it once a month, once every 2 months. I don't really keep pay too much attention to it as long as I can see it consistently growing. And whenever the market crashed, I didn't freak out. I lost, a certain percentage, and I just watched it continue to grow and get bigger over time. And that's the thing about those type of funds is the more you contribute, the higher potential returns you have over time due to compounding interest and things like that. Okay. Trading involves more frequent transactions such as buying and selling of stocks, commodities, currency currency pairs, or other instruments. The goal is to generate returns that outperform buy and hold investing. While investors may be content with annual returns of 10 to 15%, traders might like to see 10% return each month. Trading profits are generated by buying at a lower price and selling at a higher price within a relatively short period of time. The reverse also is true. Trading profits can be made by selling a higher price and buying it to cover at a lower price, known as selling short, to profit in falling markets. While buy and hold investors wait out less profitable positions, traders seek to make profits within a specific period of time, often use a protective stop loss in order to automatically close out losing positions at a predetermined price level. Traders often employ technical analysis tools such as moving averages and other type of things to help them get higher probability trading setups. A trader style refers to the time frame of the holding period in which stocks, commodities, or other trading instruments are being bought and sold. Traders generally fall into one of the four categories. Position trader, they're held for months to years. Swing trader, held from days to weeks. Day trader, positions are held throughout the day only with no overnight positions. And then scalp trader, positions are held for seconds to minutes with no overnight positions. So think of a trade would be, if you look at a lot of my videos, I do kind of week to week swing trade opportunities, because I do that kind of on the side. I do swing trading, but I also have some stocks where I'm investing in a longer term mindset. But the ones that I have every Sunday are swing trades, right? And it could be a 1 week swing trade for the most part. Sometimes it requires you to hold them for 2 to 3 weeks. But an example of like a longer term swing that I'm doing is IDEX. I'm waiting until earnings come out where it pops to $3 or above, or maybe even $4, and then I'm cashing out on that stock for sure. Unless I see it going crazy and going parabolic, then I'll ride the wave a little bit higher up and set a stop loss behind it. Okay. Investment would be something like silver. Okay, something like my startup companies that I invest in, such as GoSun or San Melix with the Be Cure products that they're now selling on Amazon. So those are investments that I'm investing in for the long term. I'm not really watching them every day. I do watch the silver spot price, but GoSun or San Melix Laboratories, I put money into them, and I'm up right now, which is great. I can sell and double, maybe even triple, quadruple my money if I sold one of the positions. But I'm not thinking that right now. I'm thinking longer term, because these companies are currently private, not even public. Whenever they do go public, then I can make that decision on, do I want to take my money and run on that. So I invested with the mindset of, I'm not going to miss this money. I believe in this company. I believe in what they're doing, and I think over the long term, it's going to potentially build wealth on the back end. Okay, so I just wanted to kind of shed some light on that here, because I see a lot of people, I follow stock twits on every one of the stocks that I buy and sell, either whether it be on a week to week basis, or if I'm holding for a longer time, I like to go and follow, the kind of, I guess, the sentiment on that position. And there's a lot of people that are so negative on the stocks that they buy, and I guess that's the thing, is your style has to come into play here, and you have to be educated, and you have to understand why you're getting into this position, and how much money are you willing to risk. Where do you see it going? If you're buying it at $1 per share, do you see it going to $2 in the future? Yes, maybe so. Does it mean it's going to go to $2 in a year? No, it could take 2 years. So you got to understand that you may be holding on to that stock for quite a while before it turns around. So the market's going to do what the market's going to do. Overall, usually the market does correct itself on any particular stock. You just got to believe in the fundamentals, the potential, and kind of have an exit point of where do you want to cash out, and what you're going to do with that money once that takes place. And same thing with trading is you want to kind of get familiar with a particular stock on their patterns and learn how to read the charts and the technicals and all that good stuff. And then from there, you can take advantage of short-term gains. But investing requires some patience, it requires some due diligence, it requires some maturity, and it requires a game plan, because just because you buy a stock doesn't mean, if you believe in it and you think, oh man, this is a $30, $40, $50 stock, doesn't mean that's where it's going right away. Okay, I can think back to, I know a lot of you probably seen the Meet Kevin, and I remember him dropping, I forgot how much money into Dave & Buster's when it was close to $20 a share. And as soon as he did it, and I remember the stock price just started going down and down and down, and I'm like, geez, I said, I wonder if he's selling. And fast forward to now, I mean, Dave & Buster's, it recovered and went a lot higher than what he paid for it. And I don't know if he's still invested in it or not, but that's kind of that investment mindset of, I'm putting money in because I believe that it's going to go higher in the future and increase my wealth. And you have to be willing to, if you're an investor, just ride that wave out. Okay, just forgive short-term losses for longer-term gains. And then trading, like I said, is more of a shorter-term mindset, and it's a good way actually to build up your portfolio. If you are trying to invest for the long term, if you don't have a lot of money, then you can do short-term gains, and then eventually start taking those profits and putting it other places to get some longer term gains in the longer term. All right, guys, that's all I have for you in this video. Make sure that you smash the thumbs up button if you found value in today's video. And if you enjoy our content, of course, subscribe to the channel and hit that notification bell. That way YouTube can let you know every time we release new content. Other than that, guys, we'll catch you in the next video.